Today's video, we're going to talk about how to build a portfolio in 2019. I want to help you to make this process simple because it can be pretty complex if you let it be, but it doesn't need to be. Picture a pie, and each slice of the pie has a different investment type that you will invest in to create a whole portfolio. So one slice could have large companies, one slice could have small companies, one could have internationals, one could have bonds, one could have real estate. So there's all these different types of investments that you can put inside of your pie to create your portfolio of investments. For 2019, what we're gonna do is the same thing that we've done for 2018 and 17 and 16, because no one can predict which slices are gonna do best. So what's helpful to do here is to use some tools online to help you determine what your appropriate asset allocation is. Typically, people call this a risk tolerance questionnaire or something like that. What these risk tolerance questionnaires are trying to decide is how aggressive or how conservative your ideal portfolio is, because what's right for me might not be right for you, regardless of our age and our investment time horizon, because we might have different abilities to handle risk. Two people the same age might say, one might say, I don't mind seeing my stocks go up and down because I know in the long run it'll be fine. But somebody else might say, that makes me sick and makes me lose sleep, so I don't want any part of that. I would prefer to be a little bit more conservative. And you can do this by going through these questionnaires and answering honestly. And when you come up with these answers, it'll show you, okay, you should be 75% in stocks and 25% in bonds, or 90% in stocks and 10% in bonds, or any sort of mix from very conservative to very aggressive. I'm gonna show you one site that you could use just to give you an overview of what different allocations look like. Here's very conservative and very aggressive, and you could click on it and it'll show you an overview of what this looks like. So here's the aggressive portfolio. 90% stocks, 5% bonds, 5% cash. Then you can click on details and it'll say, okay, of that 90%, how are those stocks broken down? Here's large blend, mid, small, international, emerging markets, and corporate bonds. And just to look at the conservative side, large is 10%, and then we've got corporate bonds 50% and cash 30%. And here's the detailed, here's the overview. So you can see these different allocations, and then you could read the description here and see what works for you and what sounds good. Like this aggressive portfolio, it says someone who won't need the money from their investment for 10 years or more. This one says someone that won't need the investments for 15 years or more. So if I'm investing for retirement, I maybe would go with this one because I'm not potentially going to be using my retirement funds for more than 15 years. Okay, let's say you have a very aggressive portfolio and you want to see what that would look like long term. You could enter a starting balance here over 30 years, that $10,000, if invested in this very aggressive portfolio, would equal $127,000. And let's just compare that to, say, a conservative portfolio. If you invested this for 30 years in a conservative portfolio, that $10,000 would grow to $91,000. Or that's the median expectation. So they run these hypothetical situations that give you this range of high to low, and then they come up with median amount. And that's the amount I like to go with, just to kind of give you an estimate and help you plan. Another thing that you could do when you're creating your portfolio is you can go through one of those Robo Advisors on sites like E-Trade or Fidelity, Schwab. They all have their own version of it. If you're online in your brokerage account, it'll be under investment types or investment selections and then managed accounts. And then they usually have a few different options. The cost increases with each one based on what you want and the level of service you want. So maybe around 1 or 1.5% will give you the highest level of service. They're going to be doing the consultations with you, and that's what I used to do with people. I would help them build the portfolio. I would call them quarterly and review those investments with them to make sure that they're on track for their long-term plan. Now, if you don't want to go with that level of service because you want to save some money, then you can do it yourself. It just takes a little bit more upfront work, but you can totally do it yourself and you could save yourself some money in the long run. But anyway, if you're looking at your firm, you can see different options, the high level of service, and then the lower one is going to be their Robo Advisor in most cases. And it'll just give you a questionnaire that you fill out online. So go through, take those questions. It's like 10 questions that say, when will you need this money? How old are you? When are you going to retire? Maybe how much you make. They might say, what did you do in 2008 when the market dropped? Or they might say, if you lost 20% of your money, how would that make you feel? Would you sell your investments? Would you hold them? And they're just trying to gauge how conservative or how aggressive you feel most comfortable. So if you're not sure, go through that questionnaire, find out your allocation, and then you can either take that and you could just invest directly with the Robo Advisor. And there's nothing wrong with that. It takes a lot of research and stress off of your plate, and you could just invest that way. They typically charge about 0.25 to 0.35% per year to manage that. So for every $10,000 you have invested, if it's 0.35, you're spending $35 per year. Now, if you would prefer to just build your own portfolio, track it yourself, then you can take that allocation and then you can plug in different funds. So say you have an aggressive portfolio and you've come over here to see the 80% stocks, 15% bonds, and 5% cash, then click details and then, okay, 25% large cap blend. Then if you're using Fidelity, you can come to their site, go to investment products, mutual funds to find their index funds and explore our fund offerings. Scroll down here and you can see large blend. Okay, so if you're looking for a large cap blend, come over here. Here's large value, here's large blend, and then you can look for the one that you're interested in. So here's an index fund. Index funds are very low cost, do exactly what the index is doing. That's a great choice. You can click on it to learn more about it. You can see the 10-year return, 12.8%, so that's pretty good. Then you would say, okay, I want to buy that one for my large cap. Then I need a mid cap blend, 20%. And so you can come over here and look for, all domestic. Let's click index funds, large blend. So you can pick one of these. You can look at their 10-year performance. They're both index funds, so they're going to be about the exact same. Gets confusing because it's like, why do you have different ones? But this looks like the total market. This is the S&P 500. Pick a large blend to fit that space. Then small cap blend. Come over and look for small blend. Here you go. So that can be a portion of your investment portfolio. It would be 15% in this case. International and emerging markets, 10% each. So let's see. We had clicked on US equity, so now let's go to international. We'll uncheck US. Here we've got emerging markets and we've got foreign large blends. You can select one of these for each of the 10% position that you're wanting to be in. And when you're looking at these, you could look at the expense ratio here. Fidelity index funds are very, very low cost, 0.0 something for pretty much all of them. So that's really good to keep your costs low. If it doesn't have performance, it means that it just hasn't been around for 10 years. So they probably created this portfolio maybe 5 years ago, or they put it together 5 years ago. So they don't have historical performance, but it's going to basically be what the index has done for the last 10 years. So that's your international and your emerging markets, and then corporate bonds. If you did want to get bonds, you just come over here. Corporate bonds, 15%. Let's go taxable bond, then corporate bond. They don't have an index fund, so taxable corporate bond, they've got this one. Expense ratio 0.45, that's also fine. I would say you want to keep them below 1% for sure, and if you can go below 0.5%, the lower the better, but not always. Sometimes you're sacrificing performance in exchange for low fees, and you don't want to do that either. So here, this gives us an option for our corporate bond section, and you could basically buy each one of those. and put together your own portfolio. So the options for you when it comes to creating your own portfolio is, one, you can take a questionnaire to help you decide how conservative or how aggressive you should be. You can go with a Robo Advisor and have them get that invested for you inside that allocation based on the answers to your question. Or you can take that information and you can plug in different index funds into each one of those pieces of that pie, and you can create your own portfolio that works for you. So when you're thinking how aggressive or how conservative you want to be, keep in mind, not only do you have a long time horizon or a short time horizon, you want to ask yourself, do I feel good about this? I do like to have different parts of the stock market: large, small, mid, internationals, emerging markets, and that sort of thing, to spread out my risk, but also to allow myself the opportunity to have growth in those different areas, because they all take their turn on what's performing best in that given year. And there's no way to predict, and there's no pattern of which one performs best in the given year. We just don't know. That's why having allocation to some of it gives you an opportunity to spread your risk and increase your returns. Another thing you could do is go with a managed account, fully managed, like that I told you about, that 1 to 1.5%. Just keep in mind they have that management fee, and they also tack on mutual fund fees inside of that. So you really have to make sure that you're getting good value for what you're paying. One thing to keep in mind with diversified portfolios is the idea that concentration builds wealth and diversification maintains wealth. There's a couple things here. You could get in a few different stocks, like say you decided to invest in stocks instead of a diversified portfolio, then you have the potential to earn much more than your diversified portfolio, but you also have the potential to lose a lot more than the diversified portfolio. So just keep those in mind, because yeah, you can get into all the hot stocks, but then if they drop, they're gonna drop probably significantly more than this basket of funds or ETFs that you've created. There still is risk with those. If you have an aggressive portfolio, which aggressive typically means it's the majority of it is invested in stocks of some form. So take a look at my prior video on understanding investment terms for beginners to help you understand the difference between a stock, a bond, a mutual fund, and an ETF, because understanding those really can help in knowing what you're invested in these portfolios, right? So knowledge is key, because you want to make sure that you're not in something that's too aggressive for you or too conservative, because if you're in something that's too conservative for you, you're just leaving a lot of money on the table and taking away from your long-term gains. So you don't want to do that either. With all of this being said, do not find yourself in the state of paralysis by analysis, because I know this can be overwhelming and it can just be a lot. So if you're feeling that way, then just go with one of those Robo Advisors, pay the fee that they're charging, and just go with it, because being invested in something and paying a fee for something is better than just not being invested because you're too afraid of the fee and you don't want to pay anything. And then you're just missing out on all these gains. Because if you're paying 0.35% and you're earning 6 or 7%, like, does it really matter? No. And in the long run, could you save yourself some money if you do it yourself? Yes, of course, but you have to make decisions that the machine can just make for you. So you just have to decide, is that something you want to do because you feel like it's worth it? Like for me, this whole time I've had my money invested in a Robo Advisor because it's just been like easy, and I could just put money in on a regular basis and not have to think about it. And that's also another good benefit of having a Robo Advisor or any sort of managed portfolios. You can just put in money every paycheck and that goes directly into the portfolio. You don't have to go in and make those different buying decisions. So now that I'm not working at E-Trade anymore and I've got a little more time on my hands, I want to create my own portfolio, which is what I'm going to do. And I'm going to take that managed fee off of there, save myself some money, because I know what I'm doing in regards to this and I want to share that with you. And if you want to do it, you can, but if you don't, then don't feel like you have to. Just go with one of those investment portfolios and you'll be fine. Let me know in the comments below if you have any questions. Be sure to subscribe to my channel if you want to see more videos like this. I am going to be doing my next video on pot stocks. So stay tuned and have a good day. Bye.